Okay, let's unpack this Salesforce. For 11 straight years now, they've held the title. Undisputed global leader in CRM, customer relationship management.
11 years. It's quite a run.
It really is. In 2023, they had, what, 21.7% of the market? That's massive.
Yeah, huge, especially when you think about who they're beating: Microsoft, Oracle, SAP, Adobe. Giants.
Exactly. You know, that kind of consistent dominance just makes you wonder, what's the secret sauce? So today we're aiming for a shortcut, a direct path kind of to understanding what makes this business software giant, well, tick.
And it's fascinating, the sustained leadership. I mean, staying on top for over a decade in tech, that's saying something fundamental about their strengths, how they've adapted.
Totally. And to really get under the hood, we've got this detailed research analysis. It's from April 23rd, 2025.
Right.
So our mission for this deep dive, basically to dissect the key parts of Salesforce. We're looking at how they actually make money, how the company's managed, its financial health.
And what the market thinks of them too, right?
Yeah, absolutely. Market sentiment, plus who the big owners are, and maybe what challenges they might be facing down the road.
And, you know, for you listening, understanding Salesforce isn't just about one company. It's really a window into these broader trends, CRM, enterprise software.
Good point.
It helps you grasp the dynamics of, well, a dominant player in the whole digital economy.
Right. We've got a stack of info here. Business analysis, management evils, financials deep dive, market sentiment, ownership stuff, risk assessment, the whole package. Our goal, distill it all down, give you the essential insights you need, cut through the noise.
Okay, so let's map out the journey. We'll kick off with the core business model, revenue, key products.
Got it.
Then we'll look at the leadership team, how they run this massive ship, and follow that with a close look at their financial stability, key numbers.
Okay. And then second half, we shift focus a bit. Look more externally.
Right. Market perception, who owns the stock.
The risks, the opportunities. And we'll wrap up with some overall takeaways. Ready to dive in.
Let's do it.
All right, Chapter 1, Business Understanding. So at its heart, Salesforce runs on SaaS, software as a service.
The subscription model.
Exactly, like subscribing, not buying outright. And that recurring subscription revenue, it was like 94% of their total revenue last fiscal year, $37.9 billion. That sounds pretty stable.
Absolutely. That's the beauty of the SaaS model, right? Predictable, recurring revenue. Investors love it. And, to back that up, they have this thing called RPO, remaining performance obligations.
RPO, right.
Which currently stands at a massive $63.4 billion. Think of it like a backlog. Contracted future revenue.
Okay. $63.4 billion future business already locked in. And a big chunk of that, $30.2 billion, is current RPO. Expected within the next year. Now, the growth rate for that current RPO is around 9% year over year. Still growing, but maybe not the explosive rates they saw before.
Yeah, that moderated growth in CRPO, it's something to watch. Could mean a few things. Maybe market saturation, maybe tougher competition for those big deals.
Makes sense. And then there's the other bit, about 6-7% revenue from professional services, helping clients set things up.
Right. Implementation, customization. It's smaller revenue, but it's crucial for adoption, keeping customers happy, making sure they renew those subscriptions long term.
So what are they actually selling? It's all built around this Customer 360 platform idea.
The central nervous system, you called it.
Yeah, for customer interactions. And then they have these core clouds, Sales Cloud, Service Cloud.
Marketing, commerce, platform, which includes things like Heroku and Lightning.
Right. The idea is pulling it all together, isn't it?
That's the promise, integration. A unified view of the customer across all those touch points. Sales, service, marketing, having that single view. Incredibly valuable for businesses.
Totally. And then you've got Data Cloud, used to be Genie, right? Apparently that's a huge growth engine. $900 million ARR, growing 120% year over year. That's wild.
Yeah, Data Cloud and Agentforce, that's their AI platform, formerly Einstein Copilot. They've apparently done over 5,000 deals with Agentforce since last October. Those two definitely seem like the big future growth bets.
But it's a lot to juggle, isn't it?
Yeah.
Tableau for data Vs, MuleSoft for connecting systems, Slack for collaboration. Keeping all that integrated smoothly must be, a challenge.
It absolutely is. That huge portfolio built through organic growth and big acquisitions. Integration is the name of the game. Delivering that seamless customer 360 vision, leveraging Data Cloud and Agentforce, it all hinges on connecting those pieces effectively. MuleSoft is key there.
All right, so market position. Number 1 in CRM, 11 years straight. That's dominance.
It really is.
21.7% market share in 2023. Leaders in sales, service, marketing, automation, over 150,000 customers globally, most of the Fortune 500. Immense scale.
Yeah, and that dominance speaks volumes. Product market fit, sales execution, and the platform is sticky. Once you're in deep with Salesforce, it's hard to leave.
High switching costs.
Exactly. Serving those huge corporations shows how critical their stuff is. And geographically, mostly America's revenue now, but potential for more growth internationally, especially Asia Pacific.
So the core promise, the value proposition, they're calling themselves the #1 AI CRM, aiming for that unified, personalized customer 360 view, integrating everything, data, functions, and now lots of AI to boost efficiency, improve customer experience, drive growth.
That's it. The holistic, intelligent view of the customer journey, using data and AI across all the clouds to empower businesses, make better decisions, personalize interactions, get better results. AI is the big differentiator they're pushing hard right now.
Okay, that gives us a solid grasp of the business. Let's pivot to Chapter 2, Management Evaluation. Who's running the show?
Well, at the very top, you've got Marc Benioff, co-founder, chairman, CEO, widely seen as the visionary, right? The guy who pioneered SaaS, built Salesforce into this powerhouse.
Legend in the space.
Absolutely. Track record of growth, big strategic bets on cloud, now AI.
But like you said, it hasn't all been smooth. There's that history of aggressive M&A.
Right. Lots of acquisitions over the years.
And then that activist investor intervention, 2022-23, that was significant.
Definitely a turning point. And interesting that the other co-founder, Parker Harris, is still around. He's CTO of Slack now. His presence probably provides some continuity, deep tech understanding.
And the M&A history, while building out the platform, did raise some flags for investors, didn't it? Overpaying, integration challenges.
Exactly. The activist pressure really pushed them towards more financial discipline, better profitability, focusing on shareholder returns.
And there have been some big recent leadership changes, too. Brian Millham, president and COO, he's retiring soon.
Right. May 1st, 2025.
And Robin Washington took on this consolidated role, President and Chief Operating and Financial Officer, COFO. That was back in March 2025.
Combining operations and finance under one leader likely reflects that ongoing focus on efficiency, financial rigor the activist wanted.
Plus, we saw co-CEO Brett Taylor leave not too long ago. That's quite a bit of churn at the top.
It does create some uncertainty, especially now with the big AI push, but Washington has a strong finance background, so that might signal stability in that area.
How have they handled pressure cooker situations before? They got through the 2008 crisis okay.
Yeah, showed resilience there.
And the response to the activists seemed pretty decisive. Cost cuts, 10% workforce reduction.
Focus on margins, big share buybacks. Was it $7.8 billion last fiscal year?
Yeah. Started paying dividends, too, $1.5 billion. Added new independent directors, even got rid of the M&A committee.
Right. A swift, comprehensive response. Addressed the core concerns. Profits, capital allocation, governance. Disbanding the M&A committee really signaled a more cautious approach to big deals.
There was also that controversy back in 2018. The CBP contract.
Yes, U.S. Customs and Border Protection. That highlighted the ethical tightrope these big tech companies walk, right? Selling to government agencies with controversial missions.
Management kept the contract, but made statements. Caused some debate, internally and externally.
Definitely underscored the challenge of balancing business goals and stated values.
How about communication? They seem pretty open with investors, right? Earnings calls, press releases, Dreamforce.
Yeah, generally high communication. Benioff's very public, too. And they've been transparent about their Office of Ethical and Humane Use, their AI principles.
Which is important, especially with AI.
Absolutely. Yeah. Fosters trust. Benioff's profile lets him articulate the vision directly. The AI ethics transparency is crucial as AI gets embedded everywhere.
And speaking of ethics, they do talk a lot about values, trust, customer success, innovation, equality, sustainability.
They pioneered the 111 philanthropy model, too.
Right. Recognized by Ethisphere. Got that Office of Ethical Use, the trusted AI principles with built-in guardrails.
All positive steps, shows commitment. But, AI itself has inherent risks, bias, privacy misuse.
True.
So continuous vigilance, adapting those principles, it's essential. The CBP thing is a reminder that practice can be tricky, even with strong pronouncements.
Okay, let's shift to where the money's going. Capital allocation. Clearly investing heavily in R&D, right? Especially AI, Agentforce, and data cloud integration.
Definitely. Got to stay competitive, drive innovation. Integrating those new techs across the whole Customer 360 platform is key to unlocking their value. Plus, still refining the existing clouds.
And M&A. Historically aggressive Slack, Tableau, MuleSoft were huge deals.
Massive.
But now, it seems more disciplined post-activists. disbanded the M&A committee.
A significant shift. More cautious, financially focused, though there were those rumors about potentially buying Informatica.
Right. Didn't happen, though.
Suggests big deals aren't totally off the table, but the bar is much higher now. Probably looking more at smaller, targeted acquisitions that fit neatly, rather than those giant transformative ones.
And they've really ramped up returning capital to shareholders. Share buybacks, $7.8 billion last fiscal year.
And another $10 billion authorized.
Plus, started paying dividends, $1.5 billion paid out, just announced a 4% increase. Yield's still low, like 0.7%.
But the payout ratio is low too, around 25%. Leaves room for future growth.
That changing capital priorities, more buybacks, dividend seems like a direct response to the activists, enhancing shareholder value.
Clearly. It aligns with what the activists were pushing for. And yeah, that low payout ratio suggests more dividend hikes could come if earnings and cash flow keep growing.
So how well are they actually using the capital they invest? Return on invested capital, ROIC, came in at 9.1% last fiscal year.
Which is a big improvement from prior years, right? FY24 was 7.1%. Before that, it was way lower, like under 1% sometimes.
Yeah, big jump. Shows that focus on efficiency and profitability is paying off. But how does that stack up against peers?
Well, compared to some others like ServiceNow, Constellation Software, Autodesk, their ROICs are higher. ServiceNow around 10.8%, Autodesk even higher.
Interesting. So Salesforce is improving, but maybe still room to optimize compared to the best in class.
Potentially, yeah. Could be differences in business models, margins, capital needs, but it suggests they might still find ways to get even better returns on their investments.
Okay, let's wrap the first half with Chapter 3, Financial Health. Quick look at the key metrics. As of late April 2025, stock price around $236 then.
Market cap, huge, $230 to $245 billion range.
PE ratio. Trailing PE looked a bit high, 37, 39-ish. But forward PE, based on expected earnings, was lower, maybe 21, 22. PIG ratio around 1.1.
Suggests the market was expecting decent earnings growth to justify the valuation.
Revenue, TTM FY25, was $37.9 billion. That's 9% growth year over year. But the guidance for FY26 was lower, 7-8%. A slowdown.
That deceleration is key. Markets watch that closely for tech stocks.
Gross margin, though, super strong, over 77%.
Typical for software, yeah. Low cost of goods.
And operating margins really improved. GAAP was 19%, but non-GAAP hit 33%. Net margin around 16.4% shows those cost cuts worked.
Definitely. Strong underlying profitability. But again, that slowing top-line growth is the counterbalance investors are weighing.
Diluted EPS, TTM FY25, $6.36. Debt to equity looked pretty low, under 20%.
And they had more cash than debt, right? Net cash position.
Yeah, total debt around $12 billion, total cash over $14 billion. That's solid.
Very solid foundation.
And free cash flow, impressive. $12.4 billion TTM FY25. That was up 31% year over year.
Huge jump in free cash flow. That gives them tons of flexibility for R&D, buybacks, dividends, anything.
Though the guidance for operating cash flow growth in FY26 was a bit lower, 10-11%.
Still decent growth, but maybe normalizing after that big jump. Forward dividend yield, modest, 0.7%. Price to book around 3.7, 3.9.
So overall financial health, based on these numbers.
Looks strong. Absolutely. Improved profits, strong balance sheet, massive free cash flow. Despite the slower growth outlook, they're in sound financial shape.
Okay. That wraps up the first half. We've got the business, management, financials. Now let's dive into the second half, starting with Chapter 4, Market Sentiment. How was the market feeling about Salesforce back in April 2025?
Well, it seemed a bit cautious, actually, despite those strong financials we just talked about.
Really? Cautious?
Yeah, the stock price had actually dropped quite a bit in the month or three before that analysis date. It was underperforming the market.
Huh. That seems counterintuitive given the numbers. Why the caution?
Probably a few things feeding into it. That slowing revenue growth forecast, 7-8%, that's a big one for a tech company.
You're right, growth expectations matter a lot.
Then there's the whole AI transition. Lots of potential, sure, but maybe uncertainty about the immediate payoff. How quickly will Agentforce really boost the bottom line?
Execution risk, maybe, and timing.
Exactly. Plus those earlier M&A rumors, like Informatica. Even though it didn't happen, maybe it made some investors nervous, hoping for continued discipline.
The fear of going back to big, potentially risky deals.
Could be. And then just broader market stuff, worries about the economy, those U.S. tariffs may be impacting tech spending overall.
Okay, so a mix of company-specific growth concerns and wider economic jitters. What were the analysts saying? Still mostly positive?
Generally, yes. The consensus rating was still buy or outperform, most analysts covering the stock seemed optimistic long-term.
What about price targets?
The average 12-month target suggested pretty significant upside, maybe 50% plus from where the stock was then.
Yeah.
But there was a really wide range in those targets. Some were much lower, suggesting less agreement among analysts on the near-term outlook.
So some divergence there.
Yeah, and we saw some firms actually downgrade the stock or trim their price targets recently back then, citing things like that slowing growth or maybe feeling the AI focus was premature in terms of immediate impact. So bullish long-term consensus, but some clear near-term caution creeping in.
Interesting disconnect between analyst targets and the recent stock performance. How did specific news hits land? Earnings calls.
Definitely moved the needle. The strong results for the prior year were good, but that cautious FY26 revenue guidance probably weighed on the stock.
And you mentioned a revenue miss in a prior quarter.
Right, that led to a drop. On the flip side, all the AI announcements, Agentforce updates, data cloud growth-generated buzz showed innovation focus.
But maybe skepticism on how fast it translates to dollars.
Seems likely. The dividend increase would mean positively return of capital. But the leadership changes, Millam retiring, Washington's new role, probably added a bit of uncertainty too.
And the U.S. tariff talk just created general headwinds for tech.
Yeah, a broader factor impacting sentiment across the sector.
What about short interest? Were lots of people betting against the stock?
Actually, no. Short interest was relatively low. It ticked up slightly from the prior month, but overall, a pretty small percentage of the float was shorted.
So not widespread bearishness, despite the recent price drop in caution.
Exactly. Suggests most market participants weren't expecting a major collapse, even with the concerns.
Okay, let's shift to Chapter 5, ownership structure. Who actually owns Salesforce?
Well, it's overwhelmingly institutional investors, the big funds, mutual funds, pension funds, hedge funds, typically holding somewhere between, say, 71% and 83% of the shares.
So the big players dominate. Who are the top holders?
Usually the usual suspects, Vanguard, BlackRock, State Street. They consistently hold large chunks, maybe 8-9% for Vanguard, 8% for BlackRock. The top 10 institutions probably hold over a third of the company combined.
And we shouldn't forget the activists from 2022-23.
Right. Their involvement led to big changes. While some might have trimmed positions since then, ValueAct CEO Mason Morfitt is still on the board, so that shareholder-focused perspective still has a direct line in.
What about insiders? Executives, board members, how much do they own?
Relatively low, actually, somewhere in the 2.6% to 5.2% range. Marc Benioff is the biggest insider holder by far, given he's the co-founder, holds a significant stake personally.
Parker Harris, too.
Yeah, he holds a good amount, too. Recently, we saw mostly insider selling, but that's often tied to RSUs vesting, needing cash for taxes.
Standard stuff sometimes.
Yeah.
Any notable buying?
Well, there was one director, Oscar Munoz, who bought about $1 million worth on the open market. That can be seen as a confidence signal. And Robin Washington made some purchases related to her appointment, but not huge open market buying from the very top execs recently.
So heavy institutional concentration, Benioff with a big personal stake. How does that ownership shape governance?
Well, high institutional ownership means those big funds have a lot of sway. Board elections, exec comp, strategy, they pay attention.
And the board itself? Mix of insiders and independents.
Yeah, which is generally good practice. And those governance changes driven by the activists, new directors, no M&A committee show that shareholder influence is real.
Benioff still holds both chair and CEO roles, though.
He does, which sometimes raises eyebrows from a governance perspective. But the increased independent presence on the board likely provides a good counterbalance. Overall, governance seems stronger now post-activist push.
Okay, heading into the home stretch, Chapter 6, risk assessment. Let's do a quick SWOT analysis. Strengths first.
Okay, strengths. Dominant market leadership, #1 in CRM, strong brand. Big economic moat, high switching costs, network effects from their ecosystem, comprehensive platform, customer 360, large loyal customer base, tons of Fortune 500 clients.
Financials looking better, too.
Right. Strong recent financial performance, healthy balance sheet, clear focus on innovation AI, data cloud, and that strong partner ecosystem adds a lot of value.
That's pretty formidable. What about weaknesses? Where are they vulnerable?
Well, that slowing revenue growth is definitely a key one, especially for a stock valued on growth. Integrating all those acquisitions, still complex, ongoing challenge.
Past M&A execution raise questions sometimes.
Exactly. Potential reliance on Benioff's leadership.
Yeah.
Recent exec changes add a bit of uncertainty there. And for some customers, the platform can feel complex, maybe expensive.
Got it. Opportunities. Where's the upside potential?
Big ones are monetizing AI through Agentforce and expanding data cloud adoption. Lots of potential still for cross-selling and upselling within the existing customer base.
More international growth?
Yeah, especially Asia Pacific. Continued margin expansion through efficiency, and maybe getting more specialized with industry-specific solutions to grab more market share there.
Okay. And finally, threats. What keeps them up at night?
Competition is intense. Microsoft especially bundling Dynamics with everything else. A macroeconomic slowdown hitting IT budgets is always a risk.
Execution risk on big initiatives like AI.
For sure, regulatory changes around data privacy or AI could cause headaches. Cybersecurity is a constant threat for any cloud provider. Talent retention in tech is tough.
Another M&A misstep could hurt.
Definitely. And those U.S. tariffs' potential impact on hardware costs for their infrastructure or on their customers' businesses. A general economic headwind.
That covers the SWOT pretty well.
Mm.
Now, briefly, Chapter 7. Let's just focus on that U.S. tariff impact conclusion.
Right. So for Salesforce, mostly indirect impact being a software company, no direct tariffs on their services.
To hit their costs.
Yeah, potentially higher infrastructure costs if tariffs raise prices on imported servers, storage, maybe 8–10% increase estimated by some. Possible supply chain hiccups for hardware, too.
And impact on their customers.
Could be. If customers in tariff-hit industries like manufacturing or retail cut their IT budgets, that could slow down Salesforce deals. Plus, tariffs add to general economic uncertainty, potentially dampening software spending overall.
Any risk to international operations?
Potential for retaliatory tariffs or trade tensions, yeah.
Right.
But on the plus side, strong demand for digital transformation and AI might outweigh some cost pressures, and Salesforce's high margins and cash give them resilience.
Tariffs might even push companies to invest more in efficiency tech.
Possibly. So overall, indirect headwinds for growth, profitability in the near term, but probably not an existential threat.
Okay, so let's try and pull this all together. Salesforce. Clear market leader, strong moat, improving financials, making a big strategic pivot to AI.
Right. But slower growth is a real factor, and executing on that AI vision carries risk. Those are the key considerations.
And the U.S. tariffs add another layer of complexity to the whole picture.
Mm-hmm.
So, what does all this mean for the future? How businesses connect with customers? And could this AI CRM giant, face disruption from somewhere unexpected as tech keeps changing? Something to think about.
It's definitely food for thought. And if you found this exploration insightful, you should subscribe to the Stock Analytics AI YouTube channel. We do more deep dives like this into companies and trends shaping the business world. Lots of analysis there.
Yeah, check it out. And please remember, this analysis is based on info available up to April 23, 2025. The perspectives here, they're informational only, not financial advice.
That's right. This discussion used AI to help aggregate and synthesize info from the research analysis. You can find details on that in the description. Always do your own thorough research.
And talk to a qualified financial advisor before making any investment decisions.
Fair.
Crucial.
Absolutely. And one final provocative thought for you to chew on. Given Salesforce's massive influence and how deeply AI is getting woven into business, what responsibility does a company this big actually have in shaping the ethics of AI in business? Are they really living up to that potential as they drive this tech shift?